Hey, Courtney Smith here. Just want to bring you up to date on the situation that occurred today. A lot of excitement, a lot of drama has occurred today. I've got up here, this is a chart of the Dow so you can see what's happening here. I'm going to focus on the stock market on this video. The idea is, the fundamental rationalization for this is that the Fed came out yesterday and said that they were going to monetize the debt that they had. They had taken on a lot of mortgage-backed securities and mortgages back in 2008, early 2009, and put those on their balance sheet. I think something over $1 trillion worth. I mean, a huge amount. They almost doubled, they over doubled the balance sheet of the Fed in these toxic assets. And what they're going to do is, as the mortgages expire, they're going to start to buy U.S. Treasuries. Now, that's the spark. Now, what that means then is that they are going to take that debt, and now it's going to be turned into cash. It's going to be turned into money. In other words, they're going to take all that debt and they're going to jam that into the banking system in the form of cash, in the form of adding reserves to the banks. And what that's going to do is that it has the potential for creating a huge inflationary spark. Not necessarily, because right now we have the money multiplier, which is a measure of how much each dollar turns over in society. It's actually below 1, which means that people, when they receive dollars, are paying down debt or saving the money. They are not spending the money. Now, the market yesterday thought that that was bullish, and then decided that today, well, wait a minute, why would the Fed be monetizing this money? Why are interest rates dropping like a rock today? And the only reason that the Fed would be doing something so dramatic would be because they've decided that the economy is in such bad shape that they want to, that they need to monetize that debt and pump it into the economy. So the stock market is down very heavily today because the monetization by the Fed is a signal that the economy is very weak. If you're a subscriber to my newsletter, Wall Street Wealth Builders, then you already know that I've been talking about this for some time. I'm not necessarily saying we're going into a double-dip recession, but we are going into a period of sustained economic weakness that will carry through the end of this year and deeply into next year. We're not going to see, normally when we see a sharp decline in the economy, we see a sharp rebound. That rebound is over. First of all, one of the things here that you can see, obviously, here's the Dow, and one of the things is you can see a potential head and shoulders bottom here, which, if it continues down, will be a big failure. Let me now also go over and show you here it's clear if we look at the NASDAQ. Here you can see the head and shoulders bottom a little bit easier, shoulder over here, shoulders over here, and we're about to break below that. I think the other thing that's very important to look at here is a formation called an island reversal, and this is also quite unusual, particularly in the stock market, but you'll see there is a gap up right here, right in this area, and then today we've got a gap down, and that creates an island, which is called an island reversal. Financials are another stock which has a big impact. Let me just go over here and show you the this is the financials and what they're doing. And you can see that this is actually much weaker than everything else. All the other sectors of the economy had rallied up into the equivalent of about this area. None of them even got close to surmounting the old highs back in April. But the rest of those indices that I just showed you had gotten up into this area. Financials never even got close. Now you can see, once again, the head and shoulders here is very clear. Here's our neckline right here. Now here's the way you trade head and shoulders. And I waited to leave to this one till last because it's the clearest. First of all, we've already broken the most recent little right shoulder. Maybe we can ignore that one from a classical charting perspective. But this is the one right here. Once we break below that low, we're supposed to go short, because that would create a head and shoulders failure pattern. One of the things I teach in my seminars is that a failed signal is a signal. ACE writer and thinker Jack Schwager points out that failed signals are even more powerful than signals because they represent something unusual happening. If a signal happens and the market goes up, in this case with the head and shoulders and the break over here, that's normal. That's exactly what we would expect. But in fact, that's not what happens when we actually see the break of the lower end here, the shoulder here. A break of that shoulder means that we've got something really unusual happening, and we need to pay even closer attention to the market when something really unusual is happening. So the trading strategy would be to sell a break of this right shoulder. Now I'm going to go back over for just a second, and let's go back over to the Dow and get that back up here, because I want to show you one other thing that's quite critical here. Here we go. And that is that what's happened is, and the equivalent there is if we break below here. But notice how there's another factor to consider, and that is that volume in general declined over the rally. See how the market rallied, but in general, volume declined. Now, it's possible that some of that is related to vacations, although that would mainly show up here in August. But generally speaking, when the market was rallying, take right here, volume went down. When the market was dropping, volume went up. Market dropping, volume up. All right? What does that mean? Volume can be considered a sign of urgency. And what this then says is that high volume means high urgency. Volume is a confirming factor for whatever the price action is. So when the market is going down, there's urgency because people are more quick and more urgent to sell the market than they are to buy the market. That's critical importance. The second thing is that in this case, you can see that so far, basically since April, that the volume has confirmed the down moves and not the up moves. And that's one reason why I never got excited about this rally over the last 6 weeks, is because it was clearly a rally that was doomed to failure. And just one of the indicators that we can look at on the chart and see is the lack of volume on the up moves, but a lot of volume on the down moves. So what's the message? Let's get to the bottom line. We are in an extended bear market in the economy. The economy is going to be weak. I'm not saying a double dip recession, but I'm saying subnormal growth, which is not what the market has been thinking. Possibly some negative quarters, but basically under 1% growth. At the same time, that's going to hit the stock market, because the stock market's going to now start to go through a period of discounting that weakness, and that earnings are not going to grow as fast as they expect. Earnings surprises will be negative rather than positive. Now, the fact that the Fed is easing dramatically is normally a supportive factor of the stock market, because increases in liquidity go first into the stock market and then they filter through to other parts of the economy. However, that's not going to be as strong a factor this time around. It's still going to be bullish, but it's not going to be as strong a factor because the money multiplier is saying that consumers are hanging on to money, but we also know that banks are hanging on to money. They are reliquefying their balance sheets for a couple of reasons. Number one, they don't see any good loans out there. Number two, nobody wants to borrow money. Corporations are sitting on the record-setting amounts of cash. Small business is saying, you know what, I'm going to build liquidity as well, so maybe I won't borrow money. And finally, the banks don't want to lend it because the Treasury has told them don't lend it. What's the action plan based on this? You've got to be playing defense in the stock market, not offense. You've got to, if you are long stocks, that's okay. But move your stops up very, very tightly. In addition, put in some hedges. Sell short some Qs, or buy some QID, which is a bearish ETF based on the Qs. Buy those types of hedges so that if the market does continue lower, you will be protected. I'm going to wrap that up. If you want specific action steps, specific stocks to buy or sell, please check out wallstreetwealthbuilder.com, and I'll talk to you on the next video. Thanks very much.